Hello, this is Marc DeCastro, Research Manager in the Consumer Banking and Community Banking Practice at IDC Financial Insights. I'd like to spend a few minutes today talking about the FDIC's plan on collecting 3 years' worth of premiums. So the plan on the table by the FDIC right now would be to collect 3 years' worth of premiums. Now, in a given year, the FDIC historically has collected about $17 billion in premiums from their member banks, or those that are FDIC insured. So this will allow the FDIC to bring in approximately $40 to $45 billion. The FDIC currently reported that the balances in that fund was about $17 billion in the second quarter, and they've had about $14 billion hits since then. So their balances are certainly pretty low. Now, one thing that they're talking about doing is possibly giving the option of some banks to be given forgiveness for the prepayments. However, we don't believe many banks will actually apply for that, simply because of the stigma of being one of those banks. Just as with TARP funds, they quickly gave the TARP funds back because it became a negative image if you did collect the funds. Now, what's going to be the impact of these extra premiums on the healthy banks, as well as those that are struggling and maybe would be teetered to fail if they're required to do this? And is this really necessary? Well, I have a few charts here to show you. So here we have the vicious cycle that I've been talking about, where you have a healthy institution at the top, FDIC premiums on the lower right, and failed institutions on the lower left. So it's a very simple process where FDIC premiums are increasing. Therefore, that's taking some of the revenue stream away from healthy institutions and making them a little less healthy. Then on the flip side, when an institution failed, well, those costs are absorbed by the remaining healthy institutions, and it just kind of continues to go into this cycle. So what the FDIC really should be focusing on is what is happening. Let's try to prevent more institutions from failing, because as the number of institutions dwindles, the premiums on the remaining healthy institutions will continue to grow, and that in turn may make some healthy institutions actually become failing, or at least unhealthy ones. One of the things I like to do is actually create a heat map to show the number of bank failures across the United States. And as you can see, the areas in green show states that have not had a bank failure, which includes all of New England, as well as a good part of the southeast, with a few exceptions. So while the number of bank failures, which is to date up to 98, will continue to grow, this isn't really an area of concern across every state in the union. So in this heat map, what we're trying to demonstrate is, well, where has actually the funds gone from the FDIC to help the failed institutions? Numbers are one thing, but it's more important when you actually look at the cost. So here we can see, not surprisingly, Georgia and Illinois have had each over $5 billion out of the fund to pay for their failures. But here's where you see other states, including Florida, Alabama, and Texas, that have had significant hits as well, and then that's followed by California. So really, where there has been significant turmoil within the mortgage industry and speculative building that has been going on, those states in particular seem to have been hard hit by the bank failures and subsequently the draw on the FDIC funds to pay for those failures. So the FDIC, as you can tell, certainly has a tough situation on their hands. They are there to protect the investors. They do have a tremendous line of credit through the Treasury if need be, but for a taxpayer, that's probably not the best thing that the taxpayers want at the moment. So what they're going to do is turn to the industry itself to try to help bail themselves out of this. Would not be surprised to continue to see banks fail, and the FDIC may in fact bundle failed banks together and try to sell them to the healthy institutions to kind of help offset this, which in turn should continue to kind of thin out the number of players, but hopefully will leave us with the healthy amount of banks across the United States. Please let us know what you think and leave your comments on our community. Thank you.